All right, now in this video, we'll be discussing some key tips that are important to consider when you buy your first ETF on an app. Because it's one thing to discuss the theory of how it works, the different considerations, the account management, for example, as well, and to, build your portfolio. But then once you actually execute on that strategy and you actually go buy your first ETF, there are some things that are important to know. For example, there's different ETFs that are maybe named in a similar way. Um, and that doesn't mean that they are the same. So you want to make sure that you're buying the correct ETF. You also want to make sure you buy in the correct way because you can place different types of orders and that will impact the way you buy your ETF. So, these are some things, some of these practical, technical things that we will discuss in this video to make sure that you can buy the ETF that you want and you actually do it correctly on the trading app that you choose. So, first of all, there's different types of investing that we discussed. So, we've discussed in the past how you can automate, for example, your investing, or how you can manually go into the app and buy it. And I guess for the start, I would recommend to just start manual because you will just be able to learn the ropes and understand how it works. And you basically go into the app, you then find the ETF that you want to buy and you just buy it manually. And then once you have done that for a few months, every month you just go in there, you buy your ETF for $100 or whatever amount you choose. And then at some point when you're comfortable with that, then you can start to perhaps automate it because I can find it a little bit, with automation, it can go a bit much sometimes when you're really confident at the start, you might like put in a little bit more, like maybe like 200 or 300, and then you have it automated. And then every single month you invest. And then at some point you might forget briefly that you had that. And then looking back at your account when you've invested a bunch of money that you didn't want to invest, it can be a bit painful. That's why I think it's good to just start slowly, start manually, and then later on decide to automate, which you can do via orders in your broker account. They allow often for, say a weekly, monthly, or bi-monthly investment, which they automatically take from your bank account to then throw into a certain ETF of your choosing. So this is something that you can set up maybe once you have a little bit more experience because it takes a bit of time just to get used to it all and to get used to learning the theory, putting it into practice. And this is what, I would recommend here. And it could, like, I don't personally check my investments a lot. I think at the start, maybe it can be a bit more thrilling to have a look at it more often. But truly, like, looking at the amount of your balance every day is a bit of a waste of time because it's a long-term investment strategy and the thing will go up and down and, in the short term all the time. It's really, yeah, like good to perhaps check in occasionally and see how it goes. But yeah, just be aware it's a long-term strategy. So, if your account drops by 0.5% on a day or something, it doesn't matter in the short run. So that's why, yeah, don't go crazy. No need to check it every day. But yeah, you don't really need to spend a lot of time on this. But obviously educate yourself further all the time. But yeah, this is just to say start manually, then automate potentially in the future. And then this is a really, really important one. Like, I definitely want you to be aware of this one because you need to check the ticker and the price of the ETF before you buy it. Now, what does that actually mean? It's that you pay attention to the price to make sure that the price of the one that you've researched online is similar to that of the ETF that you are buying on your broker and that the ticker shows up somewhere. And I will show you just what I mean with that. Basically, let's assume we want to buy this iShares Core S&P 500 ETF, correct? So what you would want to look at for is that the price that you have here that will show up is the same. So, if you go into your app and you buy an ETF, you will be able to see the quoted price here, which is the same. So if you then buy an ETF and you look at this, there's a lot of S&P 500 ETFs out there, but you want to make sure that the one that you buy has the same value to make sure that it's the same thing, because otherwise you could be buying something completely different that might be similar, but it's not the same, and it could potentially cause risks. So here you will see, this is the name. You will search up that name and you will find one that has round about this value of 512 US dollars. And so if you find something that's worth $20, then you think, am I really buying the correct thing here? So this is something very important to look out for. Another thing that's very important is, which you will find when you scroll down here under the Just ETF website that we've been showing you, um, that you look at the ticker. Now, this is really important depending on which stock exchange that you buy it on, depending on where you are located in the world. You will try to buy it from your local stock exchange, but sometimes apps also allow you to buy from other stock exchanges, which might impact the price a little bit. You want to make sure that the ticker is correct, because if the ticker shows up there in under the buying options, you will not be able to buy the correct ETF. And that's why, like, I would definitely make sure that this ticker will show up there and you will be buying, the S&P 500. And then somewhere, if you're buying it on the London Stock Exchange, you will have CSP1 or, whatever stock exchange that you choose. It will have this ticker to make sure, that you are buying the correct ETF. And I wouldn't go too crazy about this. If you find it on your app and you see the rough value of it being correct, if you see that ticker show up for a different stock exchange, and you check the fees, then, you don't have to go too crazy about it. It's going to be the correct thing. And then you can go ahead and buy it. Another very important thing is to consider whether your platform offers fractional shares. Now, this is a possibility when, for example, before when you had this ETF that cost $512, you do not want to spend $500 obviously a month to buy one unit of this ETF. You can check whether fractional shares are possible. Maybe we've discussed this before, but just to reiterate, these are, yeah, basically a proportion. So if you want to buy 100, you can now buy a fraction of that, for example, $500 S&P 500 ETF and use, your $100 budget to buy this ETF. And so you can, buy a fraction of it now, which enables you to do this. So this is really useful, if you have less of a budget or you want to invest a specific amount. And for both the platforms that we recommend here, um, in this course, it's Interactive Brokers and Trade Republic. And so they both enable fractional shares. So you can use that. That's no problem. And so it's also then really important to also be aware of trading hours, because depending on where you buy your shares, the trading hours are different. And so it's from 9 to 5:30 CET in EU markets. And this depends on where you are in the world. Because if you buy it outside of the trading hours, at the start and end of these market hours, there is a lot of volatility. So, while obviously for ETFs, there's not so much volatility. And actually, let's describe volatility for a second. It's basically, hectic movements in the markets. Like if there's a lot of activity, so the prices go up and down very quickly. And this is mostly the case for stocks, for individual stocks. For ETFs, less so, because there's so many of them that the price doesn't move all that much. But still, it might affect the price a little bit. And so it's best to buy during trading hours because the price will be quite stable then. But it probably doesn't make a big difference. But if you can avoid it, try not to trade outside of the trading hours. Try to trade from 9 to 5:30 when you buy your ETF. And so when you buy an ETF, you want to place a market order. This is very important because there's two different types of orders that you can place most of the time. You can place, for example, a market order, which is basically a type of trade that executes immediately at the best available current price. Because there's always in the market, there's, demand and supply. There's a bunch of people offering a price, and there's a bunch of people demanding to buy it for a certain price. And so the price changes. And you can set it so, for example, in a limit order, you trade and you set a maximum price you're willing to pay or the minimum you're willing to sell for. And the order only executes if the market reaches that price. So, therefore, like you want to, for starters, probably just place a market order because for ETFs, you don't want to, we're in this, at least we're looking at not waiting for a certain price before we buy our ETF. We're just looking to buy consistently all the time. And so, in that sense, a market order will do just fine because that will just capture the price that is available at the time. So, that's a little bit about that. Another And so another thing you can do is to set a stop loss order, for example, as well, which basically is an order that is automatically placed to sell your ETF once it drops below a certain margin. So, for example, let's say your ETF drops 20% below when you bought it. And then you can set a stop loss to sell that ETF. Now, this is a very common thing that people do to basically cut their losses, to ensure that when something really goes downhill, that you have some safety mechanism to automatically sell so that you avoid a painful loss. But, you can do that. You could set it to, 20% or something. This is something that's possible. 20% is a very common figure. But when it comes to ETFs, I generally don't do that. And there's a few reasons why. Um, because it's the stop loss mechanism is very good for stocks. And I know a lot of people that are, really professional investors that are using the stop loss mechanism for stocks that they pick, where they think they will outperform the market and they will do really, really well. But the problem with ETFs is that these are, less risky assets, I guess, the ones that we're teaching, because they include hundreds of different stocks. But so when we, do stock picking, we might want to look at one that outperforms the market. And when it does, however, not do that, and we have made a wrong choice, we can then set a stop loss to save us. But when it comes to ETFs, as we've discussed before, these things go up and down. And during a major market crash, like in 2008, for example, the global financial crisis, these ETFs might drop, 20, 30% or something. And then if we have a stop loss, we might risk selling that ETF at the worst possible time because the market is at a downturn. And these ETFs track the global market. So when these ETFs drop to that low point, you risk to sell it at the worst possible time when could have instead perhaps bought some shares or bought some more ETFs to, make use of that lower point. You then end up selling everything, and then the market suddenly recovers, and you're missing out on all the losses, and instead just sold it at a 20% loss, which would be honestly is such a waste. So that's why with ETFs, I generally don't put a stop loss. And you can decide, obviously your own risk tolerance. What I'm saying is definitely 100% not prescriptive. You can do whatever you want. And this is just, to explain the stop loss mechanism and why, in the sense of ETFs, you might not want to do it, but, obviously proceed at your own level of information at your own risk. And that pretty much wraps us up for this video as well. So yeah, hope you understand everything and happy trading.